Hello there, and welcome to a new issue of the Indicator Spotlight. This is something that we do about once a month, featuring a indicator from our NinjaTrader 8 library. Short little video, about 10 to 15 minutes here today, with a brief explanation of the main indicator concept, the most important functions, and how you can use this in a trading setup, along, of course, with a free download link to the indicator featured. And this time around, we're looking at a new entry to the library, the range analysis. General concept here comes from Toby Crabel and his book, Day Trading with Short-Term Price Patterns and Opening Range Breakouts. Most of you are familiar with the opening range, and if you're not, you can take a look at a previous indicator spotlight we did on that, or one of our recent webinars. All right, so basically Crabel was looking to define certain market conditions that precede trending days. The main idea here is that there is a relationship between narrow and wide ranges, so contraction and expansion. I've put up this image of a accordion here to illustrate the point, because it's the way that the market works. It's in constant change from a period of movement, followed by a period of rest, and then expanding again. So this information was then used by Crabel to choose the opening range breakouts that had a higher probability of success. And there was a few ways of determining narrow range market conditions. First, Crabel looked at the inside bar, which is defined as having a range which is completely encompassed by the previous bar. So the previous high here is higher than the current high, and the prior bar low is lower than the current bar low. And this condition is then combined with a look back period, and then identifying the narrow 4-bar pattern. So you see here we have a inside bar, and then that this range here is narrower than the previous 3-bar ranges compared individually. And this is what it looks like in a 15-minute charts of crude oil. The yellow bar here alerts us to the pattern. And as we see, we have a inside bar here. And if we count backwards, we see the look back period here. And again, that this range here is narrower than the preceding 3 bars. So he's including the inside bar in the look back period here. Later on, we see a double inside bar. That is a fairly rare pattern, and is a bar with an even tighter range following a narrow range 4-bar pattern. Also, we can see a slight difference here in the coloring of these bars. The difference here is between up and down closes, so gold for up close and yellow for down close. And there was a few other additional contraction patterns that Crabel looked at. Here we have the narrow range 7 pattern. This is defined by a range which is narrower than any of the previous 6 bars. So counting back here again, we see that this range here is more narrow, or the narrowest, when comparing to the 6 previous bars. Again, he's including here the narrow range bar in the look back period. And again, you have a inside bar narrow range pattern that is then displayed as IB7 here, inside bar 7. So you see this is an inside bar here, and it's also the most narrow bar when looking at the previous bars here. Another way of identifying market contraction is using the 2-bar narrow range, which is the narrowest 2-bar range relative to any 2-bar range within the previous 20 bars. So we're now looking at a look-back period of 20 bars, and we're taking the range of these 2 bars here, comparing it with the look-back period, and finding that this is the narrowest 2-bar range in the look-back. And that can identify a period of contraction in both volatile as well as in consolidating market scenarios. So we see here a narrower range condition here. We get into high volatility, and we have a contraction here as well. Another slight variation of this approach is the 3-bar narrow range, which is, of course, the narrowest 3-bar range relative to any of the 3-bar ranges within the look-back period. Again, 20 bars here. The range analysis indicator also comes with the option of displaying wide spreads, outside bars, 2 and 3-bar widespread patterns. And the following here, we will, however, look at the narrow range patterns, as that is most relevant to following Crabel's approach to trading the opening range. Brings us back to where we started. Many of the short-term and retail traders tend to ignore markets that consolidate, but it is exactly that type of scenario that we should be looking for in order to position ourselves. Crabel's assumption, again, was that following a period of narrow range days, a new trend would align with the opening range breakout. So we therefore applied the narrow range patterns on daily charts when selecting the opening range breakout candidates. So looking at this, we have daily bars of the NASDAQ futures contract, and we see how the narrow ranges here precede the ranging days, the trending days. And for the short term, this is one of the days followed by a narrow range bar in NASDAQ. This is a 5-minute chart, and we're using a 15-minute opening range. This is the opening range here. The red here is a feature of the multi-time frame opening range. So it's the first minute following the open. And for this situation, a short position is entered at the breakout below the opening range low. We see also a long signal plotting here, but that's just before the opening range completes. It completes with this bar here. So 5-minute chart, 1, 2, 3. And we see that we can't really break the pre-session high. Is on this as well. And then it rolls over, breaks through here. This is the premium opening range indicator that we have on here, and the paint bars and the signals come from the premium Ichimoku indicator. That is a multi-time frame trend and momentum indicator confirming the breakout, just showing with paint bars and signals on this chart. As for trade management, once the market has moved away from the open here, it should not return to this level. And if it does, it's most likely not a trending day, and the setup should be invalidated. So a trailing stop can be set at the open following the initial move out of the opening range. And first target here would be the pre-session low, and then we have the extension bands here. This is a 50% extension and a 100% extension of the pre-session range. So that's also a feature of the premium opening range indicator. All right, so for the free download here today, it's the range analysis, and you can swing by the volatility section of our library to pick that up right now. Members also have access to the library versions of the opening range and the Ichimoku. The library itself has some 125 plus indicators available for a one-time payment of $150. So that's $150 for all of the indicators, and it's a one-time flat fee. So the free download here today is found here. Just click your way through the indicator description and you will get to a download link and you can pick that up. You're also welcome to swing by our premium section and check out the premium versions of the opening range here and the Ichimoku. You'll find an overview of the various features along with a link where you can sign up for a free trial as well. All right, so with that, I'm going to wrap up the presentation here. Appreciate you taking the time and tuning in. Please leave me a comment on the video below to give me some feedback. A thumbs up would be great as well, or if you pass it on to a trading buddy via Facebook, Twitter, or via email. Thanks a lot for checking in. Have a great rest of the week, and I look forward to hearing from you sometime soon.